I'm Arun Sareen. I'm with Sareen and Associates CPAs. We have 4 offices in Virginia, in Springfield, Fredericksburg. Our main office is in Manassas, used to be in Fair Lakes. We moved it to Manassas because we ran out of room. And one in Winchester or Stephen City. And then we have one office in Hollywood, Florida.
Oh, that's the retirement option, right?
Well, yes. No, it doesn't have to be retirement. It can just be your real option, and you can work from there,
Okay.
right? But anyway, so that's our 5 offices in the U.S. We also have an office in New Delhi.
Okay.
We have a team of 50 people. We are in the top 50 accounting firms since 1998, every year. If you pick up the Washington Business Journal, you'll see our name in there. What else can I tell you? We got a whole team. We got 6 CPAs. We got 9 EAs. EA, for those that don't know, is an IRS enrolled agent that can handle all the IRS related matters. They just can't sign audits. What else? We got another 35 accountants, bookkeepers, payroll specialists, different tax specialists, stuff like that.
Mainly small businesses and real estate?
So there's no such thing as mainly, right? It's a diverse client base. From before people are born till after they're dead, from before companies are born till after the companies need to be closed out. So we got a wide array of services for a wide, diversified group of people.
Okay. So tell us about the Schedule E and reporting your real estate on your taxes.
Okay, so real estate, some people do it as a strategy, some people for wealth accumulation, and some people just fall into it. So if you're doing real estate as an investment, you have to look at 2 components of it to compare to other investment opportunities. You have to look at what is my cash on cash, or what is the actual return I'm getting. And then you have to look at what is it that I'm expecting in appreciation. Because you have real estate is one of those businesses where the assets appreciate while for tax purposes you depreciate. So you're getting tax write-offs every year on rental properties while they are appreciating. So you have to double the benefits. What is my cash flow? What is the actual rent? That is one of my returns. And on that, almost half of it, because in this area, you're getting about 5 to 7% rental return on your properties.
Sometimes we call that the cap rate?
Yes.
Okay.
Yeah, so I don't know how sophisticated the people are on the call, but not everybody would understand what cap rate means. Okay, cap rate is capitalization rate. But again, you can divide that into 2 components. One is what is the actual cash on cash? What am I getting today for the money I have put in of my own? And what am I making on borrowed money? So if I borrow money on a rental property at 4% and I'm getting a 6% return and I'm putting 20% down on my 20%, I'm getting 6%, right? On the other people's money, I'm still making 2%, but on 4 times as much money. So I'm really making cash on cash is 14%. And on top of that, if you add how much is the property appreciating, which is normally in this area at an average of 6% a year for the last 12 years, then you're really making a 20% return on your money. But a lot of people get confused and they just look at the return. saying I bought it for 200,000 and now it's worth 240,000, right? That's a 20% appreciation. But how much of it is your money and how much is other people's money? And are you leveraging it? The other people's money doesn't go up when the property value goes up, right? You're actually bringing it down a little bit.
Mm-hmm.
So the returns on real estate can be phenomenal, but depending on your income level, even if you have a loss, right? There's people who are making it. If you're single and you're making X dollars, $50,000 or less, you get to write off the whole loss. From 50 to 75, or for married filing jointly, from 100 to 150, for every extra dollar you're making, you lose the write-off instantly for 50% of it, except you get to carry it forward.
And you can carry forward the losses that you can't write off?
Right. So if your income is too high and you have passive losses, then you got to carry them forward.
There was a lot of talk a while back between passive losses and active losses. How does real estate fall into that?
Okay. So for, let's say you, Karrina, are a full-time real estate agent, right? And that is your business. And now you buy rental properties and you lose money on it, right?
And lose money on the cash on cash.
Right.
Yeah.
No, it doesn't matter. On actual cash, yeah, on cash flow, you are cash flow negative after depreciation. So
after depreciation. Okay.
Okay. So if that is the case, then you have that loss, but you are putting in at least 50% of your energy in full-time real estate. A lot of people have a 9 to 5 job, right?
I think most of our participants here have a 9 to 5 job. So let's focus on if they are just buying this on the side, just the real estate is on the side.
So if they're buying real estate on the side, then it is a passive activity for them, right? And if it's passive, and if they're making money, then it really doesn't matter. They got to pay tax on all of the profit.
What if they take all the management calls themselves? Is that considered active then?
Yeah, but are they spending more than 50% of their week on those?
Oh, that's the definition of passive income versus active income.
Right.
Okay. If you're spending 50% of your time or more in real estate, then it's active income.
Yes.
And if you're spending less than 50%, then it's passive or passive losses. I guess income's fine, right? It's just.
Well, income doesn't matter passive or active, right? Except if you are active, right? What Trump did is QBI, you don't pay 20% of the profit, you don't pay tax on it. If it's qualified business income and you are an active real estate agent, then, or an active investor, because you have multiple properties, then 20% of the profit becomes tax-free.
Oh. But what if you own one property? Will still 20% of the profit be tax-free if you own one property, one rental property?
And you are doing a regular full-time job?
Correct.
Then you got to pay tax on all your profit.
Oh. But you pay most of the tax when you sell, is that correct? Or what about annual? Let's say you own a property free and clear, and so you're collecting a net of $2,000 a month. Let's say it's a townhouse renting for like $2,800, and your net is $2,000 a month after paying real estate taxes and insurance, etc.
Right.
So that's $24,000 a year in income. How is that taxed? Tell us about that scenario.
Okay, so in that case, let's say you bought that townhouse for $600,000, right?
Yes.
You bought that townhouse for $600,000. 20% of it might be allocated towards the value of the land, right? And the other 80%, so $480,000, you would depreciate every year.
Okay.
So roughly 3% of that, or 15,000, is your depreciation write-off every year.
Okay, so from the 24,000 in your pocket, you write off 15,000 in depreciation.
That's right. So only 9,000 is taxable.
Okay. And is that taxed at ordinary income rates or at capital gains rates, or how is that taxed?
No. Okay. Capital gains only happens if you sell something.
Okay.
Till then, it is ordinary income,
Okay.
right? And if, let's say, you have multiple properties and you have 3 that are making money and 2 that are losing money, you offset the losses against the gains and pay taxes on the net amount.
Okay. What if
And
somebody has a very small income? Let's say they're retired, or their income is Social Security, like 20, 30,000, and then they have a rental property. How does that figure?
Well, are they making money on it or not making money on it?
Making money because it's free and
If they're
clear.
making money on it, let's say it's a couple that owns a little shop or something and they're making 60,000 a year and their ordinary income was 20,000.
Yes.
This 60,000 would sit on top of that and they would be paying taxes on it at
Okay.
that tax bracket.
Okay. So the thing that Trump brought in then is the QBI, the qualified business income
Deduction, right?
income deduction, which I'm trying to get this right. That's only if that's your main activity, or a lot, or what you're doing on a
If you're
full
running
time.
it as a business, right?
If you're
And
running
it's
it as a
taking up
business.
a lot of time.
Oh, I see.
If I'm in IT and I'm investing on the side in properties and buying them and working on them for 8 hours every weekend, that doesn't qualify for QBI.
Okay. So then we're in our regular, have the depreciation schedules changed at all with since Trump came in? Are we still 27 and a half years? And
No.
okay,
No.
so it's
27 and a half years, unless you're doing different improvements, like let's say you put all the new appliances and all, and you don't bundle them in, then you can write them over 7 years instead of spreading it over 30 years. You could also elect to use section 179 and write them off immediately if you are doing a replacement, right?
okay. So
So
if you're
a
switching out a
renovation,
kitchen and putting in a kitchen.
right? That's adding value to the property. Then you got to spread it over 15 years.
Okay. So what are the different depreciation schedules then with the residential real estate?
Depends. Okay, there's a whole thing.
There's a table full of tables.
Yes.
Okay. All right. And tell us the next thing.
Okay, so the first thing is you got to know what is passive versus active and whether you have a loss or a profit. And if it is a profit, doesn't really matter. If it is a loss and your income is less than 50,000 per person or 100,000 per couple, then you get to write off the whole loss. If your income goes above 100,000, up to 150 for a married filing jointly, or for singles, it's just you split that and get the half of that. Then any loss you have, let's say you made 140,000 as a couple. So half of anything in excess of 100 is 40,000. 20,000 of it is what would get washed out. So you would only get the remaining losses after that. The rest of that 20,000 keeps getting carried forward. When you go sell that property, you don't lose it. Then at that time, all of a sudden, because that asset is going away, you recognize that loss. And that becomes an ordinary loss. And so you don't need to carry it forward anymore.
Oh, so you could because we do have people cashing out now with these high prices. and
Yes.
they're just, deciding whether to cash out and do 1031 or cash out. And you're saying all these accumulated losses they could use to decrease their, well, you got your basis and then you got your gain, so they can use the accumulated losses to off of the top of the gain. Is that what you're telling me?
Okay, so all the losses they were carrying for, let's say somebody could write off 20,000 every year for 4 years, right? That's
Yes.
$80,000 sitting in the system as unused. And now all of a sudden they go sell the property for 100,000 gain, 80,000 of it wiped out the gain. So they only
Okay.
tax on 20,000.
Okay. Now, one of the people I tried to get to come here, I said, well, don't you put everything on your Schedule E? He says, I put it all in the little boxes and TurboTax takes care of it. Do you think that these auto tax filing systems are keeping track of all these things the way that you do for my properties? I mean, my things.
Okay, so it depends, right? One thing is you got to be consistently using the same software,
Okay.
right? And some of these are free softwares people will use, and then you go use another free one next year. So there's no linkage between the first one and the second one. Or if you change software and you don't bring forward every historic data from the past, then all your depreciation schedule, any carry forwards, anything else. And sometimes on certain items, the state rules are different than federal rules for depreciation. So, but it's fine for simple people with simple returns who know what they're doing.
Okay. I just know it was getting more and more complicated. That was when I just started to turn everything over and you guys do it. But
Well, yeah. So professional advice is not an expense. It pays for itself. If you make one mistake or lose one opportunity, you're going to pay more in taxes than what you would pay the CPA for 10 years of work.
okay. So have the tax filing dates changed this year?
Yes. So everybody knows that. It's May
I didn't
17th.
know it.
Okay. It's May 17th now for
Okay.
federal. And that's if you're filing an extension after that, then you also file the extension for state.
And the state dates have changed too? Virginia's changed?
Virginia has no idea what they're doing.
Oh, they don't know.
They
Okay.
don't know.
Oh, they haven't created a date?
Well, they have made a lot of funny stuff and they're still fighting between their different departments. So I would say that just wait and see. But you got to
Oh.
file state anyway by May 1st.
Oh, May 1st for the state and May 17th for federal.
Right. Depends on which state also, right?
Okay.
So.
Well, here's a question. Let's say the investment property is in Florida and the person lives here in Virginia. How does that flow through the Schedule E's, et cetera?
So let's say you make a gain in Florida.
Yes.
And you're living in Virginia.
Yes.
Right? So Florida does not tax you for the gain because Florida doesn't have income tax.
Do you have to file an income tax return in a state where you're collecting rental income?
No, but if you're doing it as a business, you have to pay sales tax in Florida on rental income.
Well, let's switch it around a bit. Let's say they have a rental property here in Virginia and they live out of state. Are they supposed to file a state income tax on rents that they?
Yes, they're supposed to pay and pay. So Virginia, if you don't live in Virginia, wants Virginia tax on it. If you live in Virginia, but you have property, say in Florida, which is at zero tax, then you get zero credit because you get a credit. Virginia will want their 5.75% or 5.85%. And then you get a credit for what you're paying another state or another country. But if you didn't pay them anything, then you can't get that deduction. So Virginia is saying, this is my tax. You are my resident, right?
Okay.
They have double standards. So if you're living in Virginia and the property is outside of Virginia, you get a credit for it up to the amount you pay another state. So let's say your property was in California and you pay 8% tax. Virginia will only let you get a write-off of the max amount you owe Virginia on that income.
Oh, okay.
Okay?
You don't get a credit back.
Right. You don't
You've
get
already
much.
paid all the taxes to California, so you're done.
Yeah.
Okay.
But if you own something in Nevada, right, and a zero tax bracket, then what happens here is Virginia will say, okay, we'll give you a deduction of 0.
Okay.
So include it in your income, but deduction, you're not getting any because you parked the money outside the state.
I see. Do you have anything else you want to tell us?
Oh, that's it.
Okay. Do we have any questions? We have 4 people in the room.
If anybody wants to jump in, they can go ahead and just unmute themselves and ask the question, or you can type it in the chat and I will ask it of our hosts.
Okay, Karrina, this is Gary. Can you hear me?
Hi, Gary. Yeah, thanks for joining us. Appreciate that.
All right, so in my case, I'm selling 2 properties here and that are currently been listed on Schedule E for several years. And so there's one of them has a loss, so one of them probably is going to break even overall. So I'm going to have a profit on that. I'm going to have a gain on both that way. Now, if my loss overcomes the gain on the first one, so that's out of 0 tax on that, and I haven't used up all that loss, can I carry that over to the other property, or is each loss property specific?
Each loss is property specific, but if you sell the property with the gain first and hold on to the one with the loss, they will collect the money on the taxes on the gain right now.
Okay.
So say you hold on to the property with the loss till next year, and right now you sell the property with the gain, you're going to pay tax on the gain.
Right. But right now I've sold 2 properties, and what I'm trying to figure out, I think one of them is going to have more loss, accumulated loss over the years than I've got gain. So in theory, I've got extra loss on that property that I'm going to gain. But
Okay.
on the other one, I'm going to gain some that I'm going to have to pay tax on. So I was wondering if I could carry over some of the loss of the other property since they're both on Schedule E.
So if you're selling both of them this year,
Yeah.
then you're going to wash the loss against the profit.
Right.
If they have already been sold this year, let's say by end of December 31, then whatever the loss is, you're going to write off if loss is in excess of the gains. If the gain is in excess of the loss, you're going to still pay the tax only on the net amount.
Yeah, okay, I've got that part, but my question really goes to, okay, I've got two gains, if you will, right? And I've got 2 carryover losses.
Right?
Okay, so one of them will carry over and wipe out the entire gain on that first property.
Okay.
But there's still, I'll just use an example, there will still be $10,000 more loss. That if I'd had 10,000 more gain, I could have used it up.
Okay.
Okay, so then on my Schedule E, the other one, I've got a gain and I've got losses. And let's say I still have $10,000 more of income that isn't wiped out. I would normally pay taxes. Can I use that 10,000 loss from the first one? Can I combine my gains and my losses so it's all
Yes.
one pile at the end?
Yeah. You'll net the 2 out.
I net the 2 out. Okay, well, that's good. Yeah, I'm okay. Thanks.
You're okay. The only mistake
He's a generous landlord. When when he likes the tenant, he gives them a break.
Yeah. So one of the things is that when you are doing that, don't forget in your calculations, a lot of people look at, oh, I paid for it this much and this is what I've lost for tax purposes. They forget to recapture the depreciation in their calculation.
Yeah, yeah.
Okay, so if you've owned it for 10 years and you depreciated it 30%, then you got to realize that that 30% is not part of your basis anymore.
Right, right. So your gain is a lot bigger, 30% bigger.
Yes, your gain is a lot bigger,
Right,
right?
yeah,
But the best thing is to make sure you calculate, doesn't matter by yourself or with your CPA or whatever, what is the real position before you sign on the dotted line.
yeah, you're right, you're right. No, that's all taken care of. I use somebody and they take care of that. I just curious for my own benefit here.
And sometimes you might take the loss and bring your income down. And the one where you have the second property, instead of doing the combining the two into one pool, you might do a 1031 on the one that has a big gain, right? And you might not do a 1031. It doesn't make sense to do a 1031 on something you have a loss. So you take the loss, get the tax write-offs, and you roll over the gain on the one that you have the gain on.
Okay,
Now-
that makes sense. Yeah. Okay, thank you.
Yeah, you're welcome.
I had heard something about depreciation is recaptured, has a different tax consequence than other parts of the real estate gain or loss. Is that true?
Yes, yes. So depreciation recapture pushes you into a 25% on the depreciation write-off. Doesn't matter you are 37% bracket or you are a 15% bracket, right? But if you are in 15% bracket, the max you're gonna pay is 15%. But if it is not depreciation, the regular capital gain is at 20% right now for federal. Virginia does not have a lower tax rate for your capital gains. So your capital gains and ordinary gains are both taxed at the same exact level.
5.75?
Yeah, 5.85 actually for 20.
Oh, 5.85.
Is depreciation
anybody-
20% across the board, or is it 15% if you have for couples less than 400,000?
So it depends on your AGI, right?
Right.
So after all your itemized deductions and all, for safety purposes, we say calculate 20% for federal, 5.85 for state. If you have the rich man's tax because you make more than 400,000, you also pay 3.85% on top of that to the IRS.
So there's no 15% depreciation. I mean, 15% capital gains
No,
category.
no.
Oh,
It is
okay.
if you're making less than say $100,000.
Okay, well, we're over that. So, okay.
15% for earners making less than $100,000.
Oh, no, okay, I can, each year they change the rate. We can check that out.
Around that, modest income. We'll call that. Now, for it to be capital gains, you still have to hold it 1 year or longer? Is that the,
Yes.
okay. Real estate is.
Now,
Now, do you have?
sometimes,
I
Right.
have little spreadsheets I put together, which are very basic and general. Do you have those kinds of things, with the appreciation and the cash on cash and things like that? Or how do you analyze your real estate?
are you talking to Garrett or me?
No, I'm talking to you.
Okay, how do I analyze them?
Mm-hmm.
I don't analyze them. Well, what I do, I put for every property, we have Excel and
Okay.
QuickBooks. So all the data, all the bills get paid I have 73 properties. So we have a QuickBooks, we put everything into a different LLC, but sometimes we have multiple because of a 1031. Then we will put them as different classes so we can press of a button, see each property, how it's doing, what's the net, everything else. And then we can also look at it as an aggregate.
So that was very interesting. So now, do you have an LLC for each property?
Yes.
Oh, tell us a bit about that, please.
Well, so LLC is like you ever have eggs in your refrigerator, right?
Yes.
So they have little compartments so they don't clash and break against each other. Same thing with properties. You don't want to put all of them in one open basket. So the more firewalls you create between the properties, if something goes wrong with a tenant or with the city or anything else, or there's a major fire, or you get sued beyond the insurance limits, whatever. So you want to separate each one into a different LLC.
But then don't you have to file a tax form for each LLC?
No, as a little guy, you can have disregarded entities so they can all go. You can put 80 properties on Schedule E, one on each column.
So each property, you've amassed 73. I know some of the people looking would be interested in following you into that path, but so each one, let's call it 123 Main Street LLC, 8455 Carly Avenue LLC.
Right. So each one should be a separate LLC. Also, that way, if you have children or anything else, or you're giving it trading properties, then like you play Monopoly, then it's easier to save a lot of recording costs by selling the LLC with the property rather than just selling the property. Because every time you sell the property, you got to pay recording fees.
Okay. And
Right.
when you sell the LLC, you just sell.
You're just selling your membership share in the LLC.
Okay, and people will buy that? Aren't they worried about taxes that LLC might owe or
No. Even like when we selling them in commercial office buildings or condos or whatever, if all the transfer fees and all the other stupid requirements of condos, you can bypass those if it's the same LLC owning it, right? It's like all you're changing is the member owner in it.
Oh, okay. Well, I guess there's no recording. Or you just record that with the State Corporation Commission?
No, it's already recorded. If I buy shares in IBM and tomorrow you sell them to you buy them from me, it doesn't get recorded anywhere. It's on the corporate books.
Right, but each LLC is recorded at the State Corporation Commission.
You update who's the officers and who's the owners and all that. Yeah, you update that, definitely.
Okay.
That's $100 job.
Oh, okay. Well, that's very interesting. So then you don't record a transfer, you don't pay grantor's tax or recordation fees or?
Well, both sides of the taxes, then getting all the title insurances again. The title insurance was with the property owned in the LLC, right?
Can you borrow with that method?
Yes.
Okay. You have to find.
The lender is looking at what? The lender is looking at the strength of the guarantor and the strength of the property.
So you have to sign personally for the LLC.
Even if it was in your name, you have to sign personally.
Yeah.
Right.
Okay. Okay. Just learning. Do we have any more questions? No? All right. Well, thank everybody for attending. Thank you, Arun. I think we took it one level deeper than, just looking in the textbooks or looking online. We have some interesting insights from you. Thank you very much.
Yeah, all I say to people is, if you need information, just Google it. If you need knowledge, then you come to us.
Okay, yeah, because I feel like this was level 2. Level 1, you can look at and read online, and then there's some more insights to be gained from somebody
Yeah,
that.
or you go to your barber or your a lady doing your hair, and they tell you sit in the chair and they give you all the advice you need.
Well, I don't know, but so do you, with the 73 properties that you've owned, do you pay much income tax each year, or is most of
Oh, you
it?
better believe it. You better believe it.
Oh, you do? Okay. So
I have
you
no
can't
comment on-
hide all your income then?
What's that?
Now, I guess, let's just come back a little bit here. Let's say if somebody has a regular townhouse purchased at, let's say, 450,000, that they're renting out at 2,300 a month, and after they've put down 20%, so their cash is pretty much zero.
Right.
Yeah, their cash return each year is pretty much zero, because with their 20% down, the rents are just about covering the debt service.
All right.
Then from there, they'll have depreciation write-offs, and perhaps they'll have some maintenance fees and realtor fees, etc. Can they write those losses off against their income?
Depends what income bracket you're in.
150,000.
Right. So if it's passive losses from the property, then from passive activity, they can't write it off. They can carry
So
it
that's where
forward.
they just accumulate these passive losses,
That's right.
which they can use when they sell the property against the capital gain.
Right.
Okay. All right. Well, thank you. Thank you for hosting. I don't think we have any more questions here.
Excellent.